Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SoFi Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we really get going, we need to do a quick shout out for StockOracle.
Right, there is a special 14-day trial link right down in the description for you guys.
Just a heads up, it is an affiliate link, meaning the channel may earn a commission at absolutely no extra cost to you.
Yeah, and we want to be super clear here. StockOracle is an AI-aided stock research platform. It is not financial advice, and it's definitely not a trading signal service or like a real-time market data feed.
Exactly. And, their AI insights and valuation estimates, well, they can be incomplete or sometimes just wrong.
Right, so always verify the important facts yourself before making any moves.
Okay, with that out of the way, let's get into this SoFi situation because it is fascinating.
It really is. Okay, so you know those optical illusions where you stare at a picture and it's clearly like a majestic soaring eagle,
Oh, yeah, but then you shift your perspective just a fraction of an inch.
and suddenly you're looking at a sinking ship.
Right.
That is exactly the visual whiplash you are probably feeling if you hold SoFi Technologies in your portfolio right now. Our mission today is to decode what might be the most frustrating market mystery in all of fintech right now.
Frustrating is putting it mildly.
Seriously.
Yeah.
I mean, you look at the headlines and you see a company that is absolutely crushing earnings, just blowout, record-breaking top-line growth. But then you look at the stock chart, and it's plummeted nearly 38% year to date.
The disconnect between the press release and the actual price action, it's just staggering.
It makes no sense on the surface.
Right, but when you have a market environment completely saturated with algorithmic trading and, instant headline reactions, the gap between management's highly polished adjusted figures and the hard, unvarnished GAAP reality.
That's where the real story is.
Exactly. That is where the true narrative of a stock lives. Wall Street is pricing in a completely different reality than the retail investor who just sees a 40% revenue beat on their app and assumes the stock is going straight to the moon.
Well, let's start with the eagle before we go looking for the sinking ship, because those Q2 2026 numbers are objectively a blockbuster. I mean, on the surface anyway.
Oh, yeah, absolutely.
We are talking about adjusted net revenue hitting $1.21 billion. That is up 40% year over year. The money is genuinely just flooding through the door right now.
And it's not just vanity metrics either.
No. Adjusted EPS came in at 12 cents, which is a 50% jump. Adjusted EBITDA rose 44% to nearly $358 million. And their lending segment, it was an absolute monster.
Record loan originations, right?
Yeah, hitting $14.8 billion. That's a 69% increase, which drove that specific segment to $725 million in revenue alone.
So the consumer acquisition engine is undeniably firing on all cylinders. I mean, the sheer velocity of those originations proves they have captured significant market share in a lending environment where, frankly, legacy banks are actually pulling back.
Right, and the data shows their whole everything app thesis is totally materializing.
Yeah, the multi-product adoption.
Exactly. So T5 members are now using an average of 1.54 products each, which is an all-time high. But the metric that really jumped off the page for me was the cross-sell rate.
The 51% figure.
Yes, 51% of new product openings are being driven by existing members. That is a completely closed-loop ecosystem.
It creates this tremendous gravitational pull.
Yeah, a customer comes in to refinance a student loan or get a personal loan, and the friction to open a checking account or an investment portfolio is so incredibly low that they just fall right into the rest of the product suite.
And in consumer finance, customer acquisition cost, or CAC, is the single biggest drag on profitability.
Right, marketing is wildly expensive.
Exactly. So when your existing base is driving more than half of your new product adoption, your blended CAC just plummets. It's the holy grail metric for a neobank.
Okay, so I'm looking at that 51% cross-sell rate, and it makes zero sense to me that they aren't just minting absolute fortunes.
Wow.
I mean, if you don't have to pay marketing dollars to acquire that second or third account, the profit margin should be compounding exponentially, shouldn't they? Every new product should be pure gravy.
You would think so.
Yet, we have KBW analyst Tim Switzer calling this blockbuster quarter a quote-unquote lower quality beat.
Yeah.
I just don't understand how a 69% jump in loan originations gets brushed off as low quality.
So Switzer's critique cuts right to the heart of how traditional banks generate revenue versus how tech companies generate revenue.
Okay, unpack that.
The massive growth we just talked about, it came predominantly from expanding the balance sheet. SoFi made more money because they were simply holding more loans and absorbing more capital requirements.
So it didn't come from organic, structural margin improvement.
Exactly. They grew the aggregate profit by taking on significantly more volume and risk, not because the fundamental financial machine became exponentially more profitable on a per unit basis,
So they didn't get better at banking, they just did a lot more of it.
which requires a ton more capital tied up in the background. And that leads directly to the profitability paradox that is currently terrifying institutional money.
The gap numbers.
Yeah. Despite all those massive adjusted EBITDA metrics that management loves to highlight, SoFi's trailing 12-month net margin on a GAAP basis is sitting at a deeply negative 19.79%.
A nearly 20% negative margin when you strip away the management adjustments. The delta between the non-GAAP presentation and the bottom line GAAP reality is a literal chasm.
It's massive.
And this brings us to the specific red flag that triggered the massive post-earnings sell-off. Management raised their full-year 2026 revenue guidance to somewhere between $4.75 and $4.85 billion.
Right, which implies a 32 to 35% growth rate.
Which, by the way, is a deceleration from the 40% they just posted. But the true killer, they kept their adjusted EBITDA and EPS outlooks completely flat.
That is the red flag.
They are telling the market, hey, we are going to generate significantly more revenue, but it's not going to translate into a single extra penny of profit.
The incremental revenue is just vanishing before it hits the bottom line. And, CFO Chris Lapointe tried to cushion this by pointing out they have, quote, too many large, attractive growth areas to invest in right now.
Right. Deploying the classic Silicon Valley narrative.
Exactly. Deferring current profitability to capture market share and ensure future dominance.
I have to play devil's advocate on that, though. Amazon notoriously ran that exact playbook for over a decade.
Oh, for sure.
They plowed every single dime back into AWS and logistics infrastructure, operating at near zero margins, and Wall Street rewarded them with a massive valuation premium. So why is the market so viciously punishing SoFi for doing the exact same thing? If you are building a financial super app, shouldn't you be spending heavily to build the infrastructure?
Well, the market's patience for the Amazon playbook has completely evaporated in the current macroeconomic cycle.
Especially for fintech.
Exactly, particularly for companies operating in the financial sector. Pure software or e-commerce can eventually flip a switch and let margins expand. Lending is entirely different.
Because it takes capital.
Right. When incremental revenue doesn't flow down to incremental profit in a fintech model, it signals forward margin compression. It tells analysts that SoFi is essentially just buying that top-line revenue.
Oh, wow.
Yeah, if you are spending $1 to make $1 in a mature interest rate environment, Wall Street assumes you lack true operating leverage.
Okay, so if they are justifying this margin compression by pointing to heavy reinvestment in their tech infrastructure, we need to look at the segment that is supposed to be the crown jewel of this whole operation.
The technology platform segment?
Yes. This was designed to be the high-margin SaaS-style business that diversifies SoFi away from being just another capital-heavy lender. But in Q2, revenue for this tech segment dropped by a staggering 23% year over year.
That is a catastrophic contraction for a segment that is supposed to command a software valuation multiple.
Totally. And what absolutely shattered the diversified SaaS narrative for me was the detail that this 23% decline was triggered by the departure of a single large client.
Just one.
Oh, really? If losing one client blows a hole that massive in your star diversification segment, your competitive moat doesn't exist. It's a puddle.
It's incredibly fragile.
I just don't see how institutional investors can underwrite a tech multiple when the platform's revenue is that concentrated.
They can't. And that structural weakness is the linchpin of the bear thesis. The enterprise B2B tech sales cycle is notoriously long.
Right. You can't just replace them overnight.
Exactly. Replacing a whale client takes 12 to 18 months of lead time, pitching, and integration. It is not something you fix in a single quarter.
So what happens in the meantime?
The immediate consequence of the tech platform stumbling is that it forces SoFi to rely even more heavily on its core lending segment to drive the overall corporate growth targets.
So they have to make up the revenue shortfall by leaning right back into the exact capital-heavy business they were trying to diversify away from.
Precisely. And consumer lending exposes them directly to macroeconomic headwinds. You are essentially trading high-margin recurring software revenue for interest rate sensitivity and consumer credit cycles.
Well, let's evaluate the armor they are wearing into that macro battlefield then. Because if they are forced to be a heavy lender, we really need to look at the balance sheet.
Which is actually a bright spot.
It is. Honestly, the metrics here are fortress-like. Tangible book value grew a massive 80% to $9.5 billion, which breaks down to $7.34 per share.
That's huge.
Total deposits are sitting at $45.5 billion. Their total capital ratio is 18.8%, which completely crushes the 10.5% regulatory minimum.
Yeah, management has been incredibly disciplined there.
Even their credit metrics are defying gravity. Personal loan net charge-off rates actually fell 70 basis points down to 3.7%. They're lending more, but their default rates are dropping.
The foundation is undeniably robust, and driving deposits up to $45 billion provides them with a remarkably cheap source of funding compared to tapping the wholesale debt markets.
So if deposits are surging, defaults are dropping, and the capital ratio is nearly double what regulators require, the institutional panic feels completely overblown to me.
Really?
Yeah, I mean, they are sitting on a mountain of cash and operating with a massive safety buffer.
Why are analysts treating this balance sheet like a liability instead of an asset?
Okay, so the balance sheet itself isn't the liability. The nature of the business model is. A fortress balance sheet is still attached to a consumer lending engine. Institutional investors use a metric called beta to quantify this risk, and SoFi carries a high beta of 2.23.
Meaning it is more than twice as volatile as the S&P 500.
Correct. The analogy I'd use is driving a high-performance sports car on an icy mountain road.
Okay, I like that. The suspension and the brakes, which are the balance sheet and the capital ratios, might be world-class. But the environment itself amplifies every tiny mistake. Because SoFi is so heavily dependent on personal loans, any unexpected deterioration in macro credit conditions, like a sudden tick-up in unemployment, will hit their earnings disproportionately hard.
So they're hypersensitive to the macroeconomy.
Exactly. Portfolio managers know this. If they see macro weakness on the horizon, they dump high-beta consumer lending names first to de-risk their portfolios, regardless of how strong the individual company's capital ratio is.
Which perfectly explains the violent technical tug-of-war we are seeing in the market sentiment right now.
Oh, the volatility has been insane.
After earnings, the stock took a brutal 9% hit, briefly touching a 52-week low of $14.88. Then, almost immediately, it staged a massive 10.5% bounce on incredibly heavy volume, closing around $18.03.
Right.
But the broader trend is still ugly. It's down 37.7% for the year.
So that volume on the bounce tells a very specific story. Day traders and algorithmic systems saw the price plummet to 14.88, looked at that 7.34 tangible book value, and decided the downward momentum was exhausted.
So it was a technical trade.
Yes, it was a technical bargain hunting operation, not a fundamental reassessment of the company's long-term value.
The major institutions are definitely not reassessing it positively. I mean, Morgan Stanley cut their price target to $15.
Yeah.
Mizuho slashed theirs from 29 all the way down to 22.
Big cuts.
The consensus across Wall Street is just a neutral hold with an average target of $19.58. Nobody's pounding the table for this stock.
Yeah.
But the data point that screams the loudest to me is the insider selling.
Oh, the insider flow, yeah.
Over the last 90 days, there's been a net reduction of over 238,000 shares by the very people running the company.
It is the ultimate actions speak louder than words indicator. Seriously. If management truly believes their own earnings call narrative, that this massive reinvestment is going to yield market dominance, and that the margin compression is just a temporary phase, they should be backing up the truck to buy shares at 52-week lows.
They should be buying everything they can.
Right. Instead, they are quietly liquidating positions. As an investor, that insider exit speaks volumes over the polished PR spin.
And institutional investors track insider flow relentlessly. Insider selling at absolute lows confirms the institutional bias that the stock is dead money in the near term.
It's a huge red flag.
Yeah. The synthesis of this sentiment is clear. Retail traders are playing the volatility of the bounce, but the institutions and the insiders are sidelined. Wall Street is demanding a fundamental, quote-unquote, show-me moment before they commit long-term structural capital to this suck.
They're done buying the projections.
Exactly. They want the proof. Well, let's talk about how they get there, because there actually is a turnaround blueprint for what that proof looks like. There are catalysts on the horizon that could flip this from a penalty box hold to a buy.
The biggest one being Q3.
Right. The most critical one is Q3 2026 earnings coming up in October or November. Management absolutely must raise their EBITDA and EPS guidance alongside revenue. They have to demonstrate actual operating leverage.
If they post another quarter where top-line revenue beats expectations but they hold profit guidance flat, the market will punish them even more severely than it did in Q2.
The narrative that they are simply buying growth will be cemented permanently.
Exactly. The reinvestment phase has to start yielding demonstrable GAAP earnings power.
They also desperately need to announce a major new client win for the technology platform to backfill that 23% crater.
You can't just lose a whale and brush it off.
No, they need to show they can still close enterprise SaaS deals. They're also rolling out new AI-powered tools like SoFi Coach and Composer, which is that AI investment agent they acquired.
Right, the AI integration.
If those tools can meaningfully lower customer service overhead or boost engagement to drive further cross-selling, it might provide some of that margin expansion the market is starving for. Plus, technically, traders are watching that $16 to $17 support level to see if a true higher low is established.
And, from a valuation perspective, the setup is actually incredibly compelling if you believe management can execute.
The PE ratio.
Yeah, the stock is trading at roughly 20.9 times projected 2027 earnings of 80 cents per share. Paying a 20x multiple for a company generating 40% top-line growth is objectively cheap.
But that entirely hinges on the assumption that the 80 cents of earnings will actually materialize. Wall Street is pricing in the risk that management won't be able to squeeze that profit out of the machine they've built.
The burden of proof has shifted entirely. I mean, they proved they could acquire millions of users. They proved they could cross-sell to them at a 51% rate. Now they have to prove they can do it profitably under strict GAAP standards.
The journey here is just a fascinating study in corporate growing pains.
It really is.
SoFi has built a phenomenal consumer acquisition engine. They are operating from a fortress balance sheet with surging tangible book value. But they're trapped.
Trapped by their own success, in a way.
Yeah, trapped by the massive reinvestment costs required to sustain their growth. Trapped by a fragile B2B tech segment where single client concentration risk is a glaring vulnerability. And trapped by a skeptical Wall Street that is utterly exhausted by adjusted metrics.
They have hit the classic maturation wall that every disruptive fintech eventually faces. It forces a deeply uncomfortable identity crisis.
The tech versus bank debate.
Exactly. Are these companies hyper-scalable software platforms that deserve the premium tech multiples they IPO'd with? Or are they, beneath the slick UI and the Silicon Valley branding, just traditional capital-intensive banks subject to the same macro-gravitational pull as, say, JP Morgan or Wells Fargo?
So basically, a traditional bank wearing a tech bro hoodie.
That's a great way to put it. And if SoFi is ultimately just a bank constrained by rigid capital requirements and the whims of macro credit cycles, then this 38% stock beating isn't some temporary anomaly.
It's a permanent reality check.
It's the market structurally resetting its expectations and stripping away the tech premium once and for all.
So if you are holding SoFi, or frankly, any disruptive fintech in your portfolio, you really have to look hard at the underlying mechanics of how they actually make their money. Are you paying a premium tech multiple for a company that is essentially dealing with traditional banking problems? Because Wall Street has figured out the difference between the soaring software eagle and the capital-heavy sinking ship. Make sure your perspective is shifted the right way.
Ultimately, the consensus is still a neutral hold, giving it a somewhat cautious bullish score long-term if they can prove their GAAP profitability, but near-term, it's a show-me story.
Definitely a wait-and-see situation. Well, don't forget to hit subscribe if you enjoyed this breakdown.
And remember to check out that StockOracle link in the description for your special 14-day trial. Let AI assist your research, but always make your own calls.
Thanks for joining us on Smart Wealth with Joshua. We'll catch you next time.